Inflation tax. Inflation tax is the tax nobody votes on, nobody signs, and almost nobody notices, because it doesn't arrive as a bill. It arrives as your money quietly buying less than it did last year. When a government or central bank expands the money supply faster than the economy actually grows, every unit of currency already in circulation becomes worth a little less. So prices rise not because things became more valuable, but because money became less valuable. You don't see this tax taken from your paycheck. You see it at the grocery store, at the pump, in a rent renewal that's somehow always higher than last year's, even though your salary barely moved. The onset is slow enough to be invisible day to day. 1% or 2% a year feels like nothing in the moment. At its peak, the effect compounds the same way debt does, except in reverse. The value silently erodes year after year until a decade later you realize the same amount of money buys noticeably less than it used to. The myth is that inflation hurts everyone equally. It doesn't. People holding cash and fixed wages lose the most, while people holding assets, property, stocks, businesses often benefit, because asset prices tend to rise with inflation while paychecks lag behind. This is why inflation tax is sometimes called the most regressive tax that exists. You never received a notice, you just quietly started affording less. Sin tax. Sin tax is the tax baked directly into anything labeled as a vice: alcohol, tobacco, gambling, sugar in some places, and it works differently from most taxes on this list because it's designed to be seen and still paid anyway. Governments added deliberately to discourage certain behaviors while collecting revenue from the people who keep doing them regardless. The mechanism is straightforward. The tax is folded into the retail price before you ever see a receipt, so the price already includes a markup engineered to make the product more expensive than its actual cost of production would suggest. The onset is immediate and visible. Unlike most taxes here, you can usually see exactly how much of the price is SIM tax if you look. At its peak, this tax becomes strange in its own right, because it depends on people continuing to buy the thing it's supposed to discourage, meaning the more effective it is at changing behavior, the less revenue it generates. The myth is that sin tax only affects people who choose vice. In reality, products like sugar taxes often apply broadly enough to catch people who never thought of their purchase as a vice at all, just a routine grocery item that quietly costs more than its ingredients would suggest.
Bracket creep. Bracket creep happens when your income rises just enough to push you into a higher tax bracket, but not enough to actually feel richer once the new bracket takes its share. Most income tax systems are structured in tiers, where each additional portion of income above a certain threshold gets taxed at a higher rate than the income below it. The problem isn't the structure itself, it's what happens when wages rise to keep pace with inflation rather than real growth in purchasing power. You get a raise that looks like progress on paper, except prices have already risen by roughly the same amount, so your actual buying power hasn't moved, but your tax bracket has, meaning you now owe more on a raise that didn't actually make you wealthier. The onset is gradual and usually goes unnoticed until tax season arrives and the number owed is higher than expected for what felt like a modest raise. At its peak, bracket creep quietly punishes the exact people it's least designed to target: workers receiving cost of living adjustments rather than genuine promotions, because the tax system can't distinguish between a raise that reflects real growth and one that simply tracks inflation. The myth is that getting a raise is always a financial win. Sometimes it's a tax bracket trap disguised as good news, where the number on your paycheck goes up while what it can actually buy stays the same, or even shrinks. Payroll tax. Payroll tax is the tax most people technically know about but systematically underestimate, because it's split in a way designed to make it feel smaller than it actually is. In many systems, payroll tax is divided between what comes directly out of your paycheck and what your employer pays separately on your behalf. And that division is not an accident. It's a structural choice that obscures the true cost of employing you. The portion labeled as the employer share doesn't come from nowhere. It comes out of the same budget your employer would otherwise use to pay you more, meaning the tax you never see on your payslip is still effectively coming out of your own earning potential, just rerouted before it ever reaches your name. The onset is invisible by design. Most workers only look at the line on their own check and assume that's the full picture. At its peak, the gap between what an employer actually spends on you and what lands in your account can be substantial, sometimes adding up to a meaningful percentage of your total compensation that never appears on any document you personally see. The myth is that payroll tax is a relatively small fixed deduction. In reality, the full cost is roughly double what shows up on your payslip, with half of it deliberately routed through a channel that makes it feel like someone else's problem.
Capital gains erosion. Capital gains erosion isn't a separate line item tax. It's what happens when inflation and capital gains tax combine to tax you on profit that was never actually real. When you sell an investment for more than you paid, the gain gets taxed, which sounds fair on the surface, except the calculation almost never accounts for how much the value of money itself dropped between the purchase and the sale. Hold an asset for a decade while prices across the economy rise significantly, and a portion of your reported gain isn't growth at all. It's the asset keeping pace with inflation while your money lost value around it. Yet the tax system treats the entire gain as if it were genuine profit. The onset is delayed by definition. This tax doesn't show up until the asset is finally sold, sometimes decades after the original purchase, by which point the inflation-driven portion of the gain can be substantial. At its peak, this erosion can mean an investor pays tax on a sale that, after accounting for the actual loss in purchasing power, barely broke even or even lost money in real terms, while still owing tax on a paper gain that doesn't reflect any genuine increase in wealth. The myth is that capital gains tax only ever taxes real profit. Often, a meaningful portion of what gets taxed is simply inflation wearing a disguise. Tariff Pass-Through. Tariff pass-through is the tax officially charged to corporations and importers but almost never actually paid by them in any meaningful sense. When a government places a tariff on imported goods, the tax is legally collected from the company bringing those goods across the border, which makes it sound like a tax on business rather than on individuals. In practice, companies rarely absorb that added cost out of their own margins. They raise the retail price by roughly the amount of the tariff, meaning the tax structure to look like it targets corporations is, in the overwhelming majority of cases, quietly passed straight through to the buyer at the register. The onset is disguised entirely. Nothing on a receipt says tariff. The increase just appears folded into a slightly higher price than the same item cost the year before. At its peak, tariffs on widely used goods can ripple through an entire economy, raising the price of components used inside dozens of other products, meaning a single tariff on one category of import can quietly inflate the price of things with no obvious connection to the original tariff at all. The myth is that tariffs punish foreign manufacturers or exporting countries. The mechanism reveals something closer to the opposite. The cost is overwhelmingly absorbed by domestic buyers who never voted on the policy and frequently never even hear it mentioned by name.
Estate erosion. Estate erosion is the slow tax that arrives at the worst possible moment, when an inheritance is being transferred after someone has already died, and grief leaves almost no room to plan around it. Depending on the size and structure of an estate, governments can take a substantial share of assets before they ever reach the people they were intended for, and the timing is precisely what makes this tax so difficult to navigate. There's no version of preparing for it that doesn't involve confronting the death of someone close to you well in advance. The mechanism often catches families off guard because the value of an estate isn't always obvious until it's formally assessed. A family home purchased decades ago for a modest sum can be reassessed at a dramatically higher current market value, pushing an estate into tax territory nobody anticipated. The onset is sudden in practice, even though the rules existed the whole time. Most people never read estate tax law until they're suddenly responsible for navigating it. At its peak, families occasionally have to sell inherited property simply to cover the tax owed on inheriting it in the first place, turning an inheritance meant to provide stability into a forced, time-pressured sale during an already difficult period. The myth is that estate tax only affects the extremely wealthy. In many places, the threshold has stayed fixed for years, while property values climbed steadily, quietly pulling ordinary family homes into a tax bracket that was originally designed for fortunes, not houses. Withholding float. Withholding float is the quietest tax on this list because technically it isn't a tax at all. It's interest you never get to collect on money that was never really yours to lose in the first place. When income tax is withheld directly from each paycheck throughout the year, that money sits somewhere, usually with the government, earning nothing for the person who actually earned it until tax season arrives and any overpayment gets returned as a refund. That refund feels like a gift, a small windfall landing once a year, but it's actually the return of money that was already yours, held interest-free for months by an entity that could have invested it, while you couldn't. The onset is built directly into the system. Withholding is calculated to overestimate slightly more often than it underestimates, which is precisely why most people receive refunds rather than owing additional money. At its peak, a meaningful refund essentially represents an interest-free loan extended without consent, the kind of arrangement that would be considered unusual if proposed directly. The myth is that a tax refund is good news. It's the return of an excess payment you were never asked whether you wanted to make, finally arriving back in your hands months after you could have used it for anything else.